There's a lot of things happening in the world right now. Donald Trump has just been elected president for his second term, the war in Ukraine is still going on, and the stock market is reaching record highs. So is now really the best time to invest in stocks? Well, before revealing the big answer, we have to understand what all this means. First of all, the war in Ukraine is still going on. While this is definitely a big deal, it's not having a huge impact on other economies at the moment. But what I'm more interested in is Trump. He's already president and he hasn't really slowed down with making changes. But how is all this going to affect the stock market? First of all, Trump wants to cut corporate tax rates, which usually help boost stock prices, especially for companies that benefit from lower taxes. While this isn't guaranteed, it's definitely a possibility. Trump also wants to reduce government regulations, which gives companies more freedom to operate. If a company has a big moat, it can really take advantage of this. However, deregulation also raises concerns about long term sustainability and oversight, especially in areas like environmental protection and financial stability. Another major thing Trump plans to do is increase tariffs on China and possibly introduce tariffs on other countries too. In theory, this could help American businesses by protecting them from foreign competition. However, it could also backfire if other nations respond with their own tariffs on US goods. That would mean lower profits for American companies, especially those with smaller profit margins. In summary, Trump's second term could potentially boost the stock market, but it all depends on the actions he decides to take. So we know Trump could either help or hurt the stock market, but what kind of companies could benefit from his policies? Well, Trump is focused on promoting oil, natural gas, and coal industries. If we look at undervalued companies in this sector, they could have significant upside. One example in the energy sector is High Peak Energy, HPK. This independent oil and natural gas company focuses on acquiring, exploring, developing, and producing oil, natural gas, and natural gas liquids in the Midland Basin of West Texas. High Peak Energy could benefit from Trump's focus on expanding domestic oil and gas production with policies that reduce regulations and promote fossil fuel development. The company also looks relatively undervalued with a price earnings ratio of 11 and a price to free cash flow ratio of 12 and a strong return on investment capital of 10.5%. On top of that, it has impressive margins with a gross margin of 83%. High Peak has recently started generating positive free cash flow growth and stopped diluting shareholders, even buying back shares. There could be decent upside here, but I'm no expert in the energy sector. I just found this company interesting given the current situation with Trump. Now that we've covered what might happen with Trump as president, we haven't yet addressed the fact that the market is at an all time high, which plays a huge role in stock picking. This suggests that the market could be overvalued compared to its historical average. While times can change and this might be the market's fair value, it's likely not the case, and here's why. The market has been booming recently, with a 25% increase just in this past year, something that's almost unheard of. When the market rises too quickly without earnings growing at the same rate, the PE ratio increases, which often signals that the market might be overvalued. This is the situation we're facing right now. Additionally, many of the Magnificent Seven, the seven largest stocks in the market, are priced for perfection. This means that if we don't perform at the best possible level, they could be considered overvalued. As of now, the market's price earnings ratio is around 30, which is significantly higher than the historical average of 16.5. This indicates that the market may be overvalued, meaning it might not perform exceptionally well in the coming years at its current price levels. So if the market is overvalued, we might think that buying stocks isn't a good idea, right? Well, not necessarily. Some parts of the stock market might not be as affected by this massive bull rally and could still look fairly cheap based on their current prices. Take High Peak Energy for example. It's a company with potential and seems to trade at an attractive valuation at first glance. However, just because a company has a low valuation and strong numbers, it doesn't automatically mean it will outperform other stocks. There could be factors hidden behind the scenes that investors aren't seeing. That's why it's crucial to dig deeper into these companies rather than just looking at the numbers. The numbers tell one part of the story, but the other part is the bigger picture, like Trump's push for increased focus on energy. So, to answer the big question, is it really the right time to buy stocks? It might surprise you, but the truth is, there's almost always a good time to buy stocks. The key is knowing which stocks to choose, even in an overvalued market. There will likely be undervalued stocks that present good opportunities. And similarly, in an undervalued market, there can still be overvalued stocks to avoid. It's not about timing the market perfectly, but about finding those hidden gems or strong investments that align with your investment style. So while the market as a whole may seem overvalued at times, there will always be specific stocks worth considering for the right reasons. But how can you tell if a stock is undervalued? Well, as I mentioned before, one way is by looking at the price earnings ratio. Even if a company has seemingly high price earnings ratio compared to the market, let's say 25, it can still be undervalued if it has the potential to achieve the growth needed to justify that valuation. Simply put, if a company can grow faster than what its current valuation suggests, then it's undervalued. Another usual metric is the price to free cash flow ratio, which focuses on free cash flow instead of earnings. This can give you a clear picture of a company's financial health, especially if its earnings are affected by accounting adjustments. Another metric that can help evaluate a company is its return on investment capital, ROIC. This tells you how effectively a company is using its money to generate returns. A high return on investment capital usually means the company is good at turning investments into profits, which is an important factor when looking at long term growth. For example, companies with a strong return on investment capital combined with stable or growing free cash flow are often well positioned to outperform the market. Additionally, it's important to think about the company's moat, its competitive advantage. A strong moat means the company has something special that protects it from competitors, like unique products, strong brand loyalty, or exclusive access to resources. This protection can make the company more stable and able to survive during tough times. For example, industries with high barriers to entry, such as technology or energy, often have companies with significant moats. These barriers might include things like expensive equipment, hard to replicate technology, or strict regulations. Companies with strong moats are often better positioned to stay ahead of competitors, grow their profits, and deliver long term value to investors. To give an example of a high price earnings ratio stock, I bought ASML about a month ago, and at the time, its price earnings ratio was in the high 30s. Normally, I consider that quite expensive. However, ASML is a high quality business with significant competitive advantages, and in my opinion, it's worth paying a premium for such a company. As Warren Buffett often says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So, if a company can justify its valuation through strong growth or unique strengths, it might still be worth buying even if the numbers seems high at first glance. Thank you so much for watching. If you're curious about how to spot companies that might be flying under the radar as undervalued, even in a market that feels overpriced, make sure to check out this video right here. It's packed with unique insights that could change the way you approach investing in today's market as a long term investor.